Beyond the Hood, stories and strategies to fuel dealer growth.
Welcome everyone to Beyond the Hood with Tractor-Zoom. I'm your host, Andy Campbell, and our guest today is Brady Brewer, Associate Professor at Kansas State's Department of Agricultural Economics. Prior to being at Kansas State, Brady was at Purdue. He did his master's and PhD at K-State, undergrad at Oklahoma State, and he's got a wealth of information to share with you today on financials, what dealers should be doing from a targeted marketing standpoint, what to look out for in terms of interest rates in the ag economy. Had a phenomenal conversation with Brady, and I hope you enjoy it just as much as I had engaging with him. Let's give it a listen. Brady Brewer, welcome to Beyond the Hood with Tractor-Zoom. How you doing?
Good. Well, thank you for having me.
Absolutely. I'm glad we got introduced, and I had a chance to work with some people at Purdue, where you were formerly, and I think the happenstance and timing was just fantastic that I got introduced to you, and now you're at K-State, is that right?
Yes, so I recently made the move. I grew up on a family farm in Oklahoma, northern Oklahoma. Undergrad was from Oklahoma State, but I did both my master's and PhD here at K-State. So this is a little bit like coming home. So it's been interesting moving back to a place where I don't have to use GPS. So it's good to be back in a familiar area of the country that I grew up in.
Good. Yeah, I imagine Kansas may be a lot like Iowa, where if you want to go north and then west, everything's a square. You just can figure it out.
Yeah, I'm back to the world of where everything's on a mile line. If you miss a turn, you just go to the next mile line.
Yep, absolutely. How far is it? It's like 10 minutes, 10 miles. It's the same thing.
Yep.
Good. Well, how about you describe a little bit about your upbringing and, going from Oklahoma and Purdue? Because, I mean, once we get into the academic world here, you've checkmarked Purdue, K-State. I mean, you're at two of the best ag universities besides you guys. I mean, maybe Texas A&M and probably Iowa State. I'd get a hard time from the Cyclones if I didn't mention them. But, I mean, you're checkmarking some of the best ag institutions in the world.
Yeah, so maybe a little bit more about my background. So I already mentioned I grew up on a family farm, very traditional north central, northwestern farm in Oklahoma. So grew cow-calf operation. We did Herefords and some other mixed breeds, and then along with the forages and obviously their big wheat operation in that area. Undergrad was from Oklahoma State University, made the trek 3.5 hours north to K-State. After K-State, I actually did a little tour of the U.S. My first academic job was down at the University of Georgia. So a lot different agricultural terrain down there in the southeastern part of the U.S. I got very familiar. First time I stepped foot on a peanut farm, I was like, I am not in Kansas anymore. Right. So that was very I really appreciate being able to learn that side of agriculture. A lot of peanuts, pecans, blueberries, obviously the Vidalia onion operations down there. So seeing that side was good. And then for the past about 7 years, I've been in West Lafayette at Purdue University. And really what I was doing at Purdue was I was working with agribusinesses, doing executive ed. There towards the end, I was helping lead the executive program. So we have a MBA program that is in agriculture, that's joint MS in agricultural economics. So I was helping lead that program and teaching in it. So I was a majority extension, but it wasn't a traditional extension because I was working with agribusinesses in the agricultural supply chain, helping them think about how to connect with their farmer customers, thinking about profitability, managing their balance sheet, their assets, and then selling to farmers as well. And then the other side of my extension appointment was, and this is something that I've kind of maintained at every university I've been at, is thinking about the finance side of agriculture. I tend to, from my perspective, if you don't have money, you can't put a crop in the ground. So I pay a lot of attention to what's happening on the financial side, i.e. what's happening at the bank level when farmers go to get their operating notes or notes for equipment and land. How is that impacting the profitability of ag?
Right. And that reminds me, too, the way that we actually got introduced is from Jim and Chad, both at Purdue, because I was talking about, okay, our dealers are servicing farmers, and they said, oh, you have to talk to Brady, because that is kind of the focus of what you're doing there. And then one of our guests that we had probably about 2 to 3 episodes ago, Dwayne Kautzman, was mentioning, how do you figure out where this equipment market is going? He's like, it gets a little simple. You follow the money. If you follow the money, you can tell where it's going. And so it brings it full circle.
Yep. So some of the research I've done is, if you think about the last 20 years in agriculture, especially in the ag credit sector of agriculture, we've had an explosion of what we typically call non-traditional lenders, which a non-traditional lender is a lender that isn't your typical deposit-taking institution. So it's not somewhere you're going to go open up a checking or a savings account, but these are major players in the financial sector of supplying money, i.e. capital, so that farms can put a crop in the ground. The early 2000s, they were 5% of the ag credit market, and now it's a little hard to estimate because data is, since they're not a regulatory institution, they don't have to report a lot of the loans that they make, but by some estimates, they could be upwards of 20 to 25% of the money that's being lent to farmers, which is a huge portion of the credit sector in agriculture. So, and when I say non-traditional, really what I'm meaning is equipment dealers, equipment financing, those types of players in the market. Sometimes it's private equity as well, but these represent a huge influx of capital to agriculture that, quite frankly, have allowed farmers to expand or access capital cheaper.
Right. Okay. So when you talk the non-traditional, you're talking maybe captive lenders from the OEMs specifically, or like maybe DLL, and not necessarily your farm credit institutions or your small community banks.
Yep. So that exactly that they meet those definitions of not being a deposit-taking organization, and a lot of times their business model is such that their main business model, the financing side, may be a complement to maybe a more traditional product that they're selling. But the fact of the matter is the farmer's benefiting and they're really helping out supplying capital to the ag market. And quite frankly, the other thing that we've been looking at is these non-traditional lenders are allowing pathways for investors, private equity people, to supply money to agriculture through various channels that they weren't able to before. So in other words, people that may not be what you would call a typical ag person wants to invest in ag, and this allows them ways through financial technology and such to supply capital to agriculture.
So then getting to that, and I just had conversations. I'm doing a tour in the northwest part of the state of Iowa, southeast part of South Dakota, and every dealer that I talk to when I'm talking about how's the rest of 24 going to go, 25, it's interest rates. Obviously, supply of equipment is in there, but it's the interest rates that are potentially limiting the farmer on their eagerness to purchase, but it's also the interest rate that they're having to pay while the equipment's on the lot. It makes a big deal right now. So, where's your take on where that's going to go? And does it really matter whether, the Fed rate, does that really influence the non-traditional and more traditional rates the same, or are there differences there?
Yeah, so we all know the story of what's happened with interest rates here over the past couple of years. We've seen historical increases in them. Now, I want to be quick, and every audience I speak to, I'm very quick to point out the increase in interest rates. The speed at which the Federal Reserve did it has been pretty historic. Historically, they like to be a little bit slower in how they raise interest rates. They just weren't able to do that because of the inflation that we saw in the macro economy. But overall interest rate levels are only slightly elevated from what I would call a long-run average. So, if you think about where interest rates are today, right now they're sitting right north of 8%, give or take, depending on where listeners are at. You could be saying, oh, that's really low, or oh, that's maybe a little high of where we are today. This is kind of a national, an average. Fixed interest rates are right around the long-term average is right at 8.2. So we're right there at that long-run kind of 20-year average. Interest rates topped out back in the 80s all the way, north of 12, 13%. So, obviously no one wants to get there, but we've kind of plateaued at this 8% mark. And really the question is where do we go from here? When I talk to farmers, one of the things I try to impress upon farmers is okay, they're not going to stay this elevated. Now the Fed, and we can talk about this, the Fed has sent a very strong signal they don't want to return to the super low interest rate environment we had pre-2020. They don't want to return that low again. So they're going to come down, but how much and when? There's a lot of signals from the Federal Reserve right now that interest rates may stay elevated for a little while.
And so I think I might know the answer to this one, but I want to hear your take. Why not? Why not the super low interest rates? And what's the benefit overall if we target at maybe a 4% or a 3%?
Well, the Fed has a dual mandate. Their mandate from the federal government of the United States is a stable money supply, which they define as 2% of inflation, and maximum unemployment, which they define maximum unemployment as 4.2% unemployment rate. For those listening, you may be saying, why don't we want 0%, no people unemployed? Well, it actually helps the economy when we have this small labor pool of people out there actually looking for a job, because that causes inflation. If there's no people actively searching for jobs, companies have to bid up people that are already working, and then that just causes inflation, which destroys the first mandate of a stable money supply. So their dual mandate is 2% inflation, 4.2% unemployment. Okay, so why don't we want to see interest rates go lower than, say, 5%? When interest rates go lower, that heats up the economy because people start maybe investing in stuff they otherwise wouldn't have. This may create jobs. Obviously, this does create jobs, which in the short run is a great thing. But this tends to lead to those boom-bust cycles, and the Fed likes to have a more even economy. Yes, a lower interest rate may lead to a 6% growth rate in GDP, but that's what leads to the peaks and valleys. And they say, no, we'd rather just have a steady 3.5% to 4% that way, and try to avoid the peaks and valleys, the boom-bust cycles that we like to, or that we have seen here recently. So that's why they don't have signaled pretty strongly that interest rates aren't going back to, that super low 4% that we saw prior to 2020.
And I think a lot of our dealers can agree with you on the fact that they want that 4% unemployment as they struggle to hire talent and retain talent, especially those super important technicians that keep their dealership running. I think that's to have that healthy pool that wants to come and work is vital for their success.
Yeah. Now, there is a lot of indicators that we can look at, Andy, to kind of really think about where interest rates, when they might come down. So I'm going to go to a little history lesson first. So, if you think back, and all to the listeners, I will fully admit that I was not alive during this time. But back in the 1970s and 1980s, when we had rampant inflation, the Fed was in a very similar position what we were in today. In the 1970s, inflation shot up. It started to come back down, and they got a lot of pressure to say, hey, we want lower interest rates so we can start investing in stuff again. People need to start buying assets. There's assets that people have been putting off replacing, equipment, buildings, so on and so forth. And what happened was the Fed actually lowered interest rates. They caved into the pressure, and inflation shot back up again. And that's where we see the super high inflation that we had in the early 1980s. Enter Paul Volcker, which was the Federal Reserve chairman under Reagan. And he came in and said, we have to reset this thing. And that's when interest rates in the early 1980s went up to 18-20%. And he told the administration, I know this is going to be rough. There are going to be people lose jobs. There are going to be companies go out of business, but we have to get a handle on this inflation, or otherwise our economy is just not going to be stable. Okay, so you hear stories, if you read some of the history from back then, he was sent like 2x4s from housing companies that had to lay off all their workers, and they all signed the 2x4 and sent it to his office. It wasn't a good time financially for the country. That's what the Fed is trying to avoid. And that's why they have started to signal we are willing to keep interest rates elevated for a period of time because they don't want to have a repeat of the 70s and 80s where they thought they got it under control, took their foot off the gas, and then that led to even further inflation in the economy. They are willing to keep their foot on the gas. And yes, it is causing some issues. It makes equipment, cars, whatever we buy as consumers, a little bit more expensive. but they don't want to have a repeat of the 70s and 80s. If you look at the Federal Reserve, they have signaled in their June 2024 meeting, there's getting ready. I think by the time this podcast is actually released, we will have an update to those expectations. But unfortunately, that'll happen next week. The June 2024 meeting, the Federal Open Market Committee is fairly split. There's some of the members say no more interest rates declines in 2024. There's a couple members of that voting committee saying we're going to have a 25 basis points or 1/4% decrease. And then there's some of them are saying 50 basis points, so 0.5% decrease. But that's all based on current data. And they are very quick to say these expectations are based on on what we think the general economy will do. If inflation does not keep continuing downward to our 2% target, until that unemployment number starts creeping up, they are very willing to keep the interest rates at this elevated level. And I know that's pretty disheartening to hear, but from their standpoint, the alternative, the 1980s rampant inflation, that's their ultimate goal is to avoid that.
Right. And two of my most recent guests, Leo Johnson, and earlier in that, Ivan Dorhout, talked about getting started as equipment dealers in the 80s and what that actually did to them and having to struggle just to barely keep it alive for years. And then, so for the current dealers, and we're talking leading indicators here, the next potential rate drop is September, correct?
Yes.
Okay, so then leading up to that, we've got, August unemployment numbers that'll come out, and probably September unemployment numbers. Any other numbers that'll come out leading up to that decision?
Yeah, so the other thing that I pay a lot of attention to is new housing starts. This is a huge indicator that the Fed looks at when I think of how the economy is doing. If people are buying houses, that's, as a consumer, that's one of the most significant purchases we can make. So if we're building homes, that's a pretty good sign. Now, this data is a little hard to interpret because of what happened during the shutdown in 2020. Obviously, people stopped building in 2020, and then we had this huge increase in new housing starts across the country. We've since come down. A couple months ago, when I was looking at the data, I've always thought, okay, yes, new housing starts are declining, and that is cause for concern. But we're really just returning back to what I would call long-term trend of where if 2020 would not have happened, where would we have been on this upward trajectory of needing new homes in the United States. We're now dipped a little bit below that long-term trend. Still, this is not panic button. This is not me saying, okay, we're headed for a recession or anything, but it is something to watch out for. It does seem to me that people are slowing in terms of new home starts. The question, though, Andy, is how much of this is due to people not having money versus people just making do with their current situation because of the higher elevated interest rates, saying, okay, we'll stay in this house for a little while. We'll move once interest rates come down and it becomes a little bit cheaper. So it's a little hard to interpret those numbers because there could be some self-fulfilling prophecy in there of lower housing starts just because less people are moving around because of the elevated cost to buy a house.
Right. And I know that the Fed's not looking at used equipment sales like they are looking at housing starts, but I'm seeing something similar in the equipment sales coming out of dealerships that, they're obviously way lower than what they were a couple of years ago. A lot of dealers refer to this as going back to the new normal, and we're probably even a little below what we'd consider the new normal in terms of new buys, and then it kind of cascades out into the used selling as well. But part of that is also due to the fact that, if you could get equipment in 21, 22, and late into 23, a lot of people did. And so they forward bought. And so they might have jumped their washout cycle to where they usually buy a once used or a twice used machine. Now they're buying a brand new machine. So now from their operation, they're set. And so I think it's going to take a little while for that hiccup to wash out and to get solid data to be able to say, this is truly what's happening in the market.
Yeah, and you mentioned earlier just the cost of keeping equipment on the lots for equipment dealers. So there's a little bit of a snowball effect here because, farmer holds out, just like the housing market, farmer holds off not wanting to purchase equipment. Now it's more expensive for that dealership to hold equipment. So now that the losses that may be incurred are now larger because just their cost of capital is greater. Which then causes equipment dealers to want to hold less inventory, which then makes the market less liquid. There's a whole snowball effect here where it compounds one another and makes the situation worse for everyone involved.
Right. It certainly does. It's kind of damned if you do, damned if you don't. A little bit of a scenario. Hey, everybody, a quick break from the show, and then we're going to get you right back to the conversation. But I wanted to take a moment to let you know how TractorZoom is partnering with all of our dealership partners to fuel their dealership growth. We're doing that with TractorZoom Pro to give people better valuations, faster access to it, and the ability to manage their inventory using AI, using large data. Even if their dealership doesn't have the capacity to develop the AI and the large data themselves, it's all there within TractorZoom Pro. And also with Anvil Pro, integrated business systems solution. You can actually cut costs by integrating solutions, not paying for all these extra one-offs, and keep people in the same solution so you're not constantly switching screens. And then you could optimize your workflows, do a lot of things with automation that technology should be able to do right now. So just two ways that TractorZoom is working with our dealer partners to really help them fuel their dealership growth. Okay, you can check out some links in the show notes. You can also go to TractorZoomPro.com to check all that stuff out. But we'd love to at least show you all the different ways that we're helping our dealership partners. Okay, let's get back to the show. Hope you're enjoying it. Kind of talking about the overall economy, and a lot of our dealers are keeping their powder dry. So if we do see interest rates drop a little bit in September, there might be a renewed buying opportunity towards the end of this year, especially, commodity prices are just horrid right now. Yeah. It's not good pretty much across the board. But if the crop looks as good as it does in a lot of part of this country, the farmers might have some profitability at the end of the year, maybe, for some equipment purchases. Not like they have in the past, but there's potential.
Yeah, so what I've been telling farmers is, you can't keep putting off these equipment purchases forever, right? But they've got to be strategic, right? Mm-hmm. They're not going to be able to do a wholesale change. They're going to have to figure out what pieces are vital for me to put the crop in the ground next year efficiently and profitably. And that's what they need to focus on, for the profitability of their operation. So as an equipment dealer, that's where I would be focusing on is when you're talking with a potential customer, looking at their operation to fully understand what are the pieces they have to have, because they're going to be holding off on some of the purchases that probably should be made, but there's some that they can't put off any longer.
Mm-hmm. Yeah, and I'm glad you mentioned that, because we're working with some dealers and actually teaching a workshop here in a couple of weeks, talking about really selling the whole solution as an equipment dealer to the farmer, and helping being their consultant, not just trying to sell iron, but really looking at their whole situation. And the way you phrased it was good, of looking and saying, okay, you can't put this off forever, but what do you need to advance your operation and be set up the way you need to be set up next year, knowing that it can't, you're not going to turn over and might not have a massive mud deal, but be prepared at least.
Yep. No, I completely agree with that. The one, again, I hate to be the bearer of bad news on this financial situation. You made the comment of maybe we'll see a rate decrease in September. Mm-hmm. I really don't think that's likely. The latest inflation numbers actually had some of the inflationary measures that were released just here a couple weeks ago ticking back up very, very slightly, like from 2.6 back to 2.7%. But still, that's not the direction they want to see it going. So if I had to, get out my crystal ball, I really think the next couple FOMC meetings, it won't be till October, November till we're going to be discussing a rate decrease, if at all.
Yeah, I'm going to go put on my rosy-colored glasses and pretend I didn't hear that. So, but while we're talking about farms and like interest rates and down to the ground level, boots on the ground, farm characteristics, we had kind of set this up as a topic earlier about farm characteristics, and I think this is part of the research that you do. How do farm characteristics influence interest rates?
Yeah, so it all comes down to risk. Thinking about how the farm's characteristics impact the risk that potential customer brings to the lending institution. Except when you think about those non-traditional lenders, there are deals to be made. There's also bundling that happens if you do all your business with one particular lender. Maybe you're getting, this is the same as a quantity discount for seed. lenders do that as well. I think risk typically leads the day when coming to pricing, especially there's a lot of worry right now with these lower commodity prices. So a lot of the trainings I do with ag lenders across the Midwest, they are worried about maybe some of the risk profiles of some of their farmer customers. And the scary thing about the ag credit markets is that the tails drive the average. And what I mean by that is if you think back to the 1980s as an example, what happens, especially for some of these small rural hometown banks that may only be 230, 300 million in size, all it takes is a couple customers to default, go non-performing status, and then that makes it to where the bank's capital, when you think about when they get regulated by the Federal Reserve or FDIC, they have to have so much cushion on their balance sheet. All it takes is a couple of customers, and then all of a sudden the bank is getting scrutinized from their regulators, and that means that they have trouble issuing additional credit to their farmer customers. So when I say the tail drives the average, in agriculture, what we've typically seen is all it takes is a couple farmers at some of these small rural hometown banks, or any lender for that matter, and that can impact what that lending institution does for a lot of the farmers. So, that impact again is sort of like on the cost to the dealerships for their cost of carrying the equipment. It's a snowball effect again, because those farmers default, and now the bank is giving the good farmers less money, or they have to increase the price, and then the interest rates, we enter a whole new environment.
That makes sense, because we've actually had an increase in the amount of conversations we have with our lending partners. So TractorZoom and TractorZoom Pro is used by a lot of farm credits and ag lending institutions across the country, and there has been a heightened conversation lately about the risk. The lending risk out there, and in particular, they have buckets. They call them different things, but the at-risk farms, and there's a lot more scrutiny going on right now, and the need to get down to transparent, real-time data on what those chattel appraisals are and where that balance sheet and those ratios sit.
Yeah, so my advice to farmers is shop around. I know that's what you guys at TractorZoom probably don't want me to be telling the farmers, but from a farmer perspective, and quite frankly, this does help the lenders because it spreads the risk out among multiple lending institutions. So there are some benefits there. But I always tell farmers, shop around, because this is what's going to, you just get a sense for what's being offered out there. But B, sometimes on a particular deal, certain lending institutions can do some things that others can't. So that's one of my top tips to farmers is, yes, it might be convenient to do a singular lending institution. From a theoretical perspective, that's what minimizes costs, just thinking about your cost of labor to set it up and the transaction costs. But from a risk perspective, it minimizes the farmer's risk and the lending institution risk to kind of spread it out across multiple lending institutions.
Yeah, I'm glad you brought that up. And speaking kind of from our dealers and our lenders too, I think they're philosophically in the same camp of we've got to do what's best for the farmers. But even on a personal note, one of the earliest stories that I ever remember, my dad telling me, because he got his start in the late 70s and early 80s, he said, do not have your short-term loans and your long-term loans at the same lender. And he had a real instance where we were going to have the farm foreclosed on us by one institution, and he was at least able to go to the other institution and borrow money within hours of being foreclosed. And it was a little bit of a risk by the other one, but paid off in the long run. They've got our loyalty for life. But he said if it would have all been in the one, game over.
Yeah, it's equivalent to insurance. Spreading your loans out across multiple lending institutions is the equivalence of like insurance for money. Doesn't always work out. I'm glad to hear in that particular situation it did, because that's really what the intended effect is going to be. Is that okay? I've built this relationship with this other institution. If something goes bad with one, maybe I'm not able to pay on one particular loan, and that relationship goes a direction you don't want it to. You have this built up relationship with other people that you can just step right in and keep on operating to get the crop in the ground. Now, coincidentally, one of the things that I track in my research is looking at the indebtedness of farms that do this. And it is true, farms that have a higher leverage ratio, so a higher debt to asset ratio, so more amount of debt relative to assets, are a lot more likely to go use these multiple lending relationships. I suspect there's a risk aspect to that, kind of what we have been discussing here over the past few minutes. But I also suspect that these are also the farms that are growing as well and leveraging some of those relationships to get the capital they need to grow their farms. So we unfortunately weren't able to actually track like the growth of the farms in the study, but we were able to track like the size and how many acres and what they produce. Larger farms tended to have more relationships with lending institutions, and I suspect that's a big reason. It's just that they're growing, right, and leveraging all the resources they have available.
Right, and from a lending institution standpoint, if you've got a larger farm, I mean, you've got land behind it, and then it makes it a less risky asset or a less risky lending partner. And on that thread, because we work with quite a few dealers who use our systems to do predictive marketing and targeted sales approach and everything. And so one of the integral pieces to do that is what data points are out there that we can start to say, okay, here's our total area of responsibility, here's our territory. How do I know which farmers are more likely to purchase from me or to be a better opportunity for my salesperson to call upon? I mean, is it strictly acres that they have, or are there other characteristics that you think a farmer has that makes them a better opportunity to buy equipment?
Yeah, so I think this comes down to the relationship and what I would call the buying behaviors of the farm. The acres is certainly going to be correlated, but I think this is where you have to get to know your potential customers and really learn what their goals and objectives are and ask those questions. In the research we've done, we've typically segmented farmers in their buying behaviors based on some of how they want to interact with the rest of the agricultural supply chain and how they manage their crop. On the surface level, there's farmers that are going to do business with you because of the relationship they have with the salesperson. These are farmers that trust your salesperson, and that's what they look for out of doing business with your company. They want a salesperson that they can trust for all of their needs for whatever products and services you provide. So in this case, equipment. And I know that's encompassing because equipment touches every sector of the farm. So that's a pretty daunting task for ag equipment salespeople because you have to be knowledgeable of the entire farming operation. But the relationship farms we've found tend not to be the ones that are on the cutting edge when it comes to technology adoption, tend not to be on the cutting edge when it comes to equipment adoption either. Really, in all aspects, they tend to be laggards when it comes to progressing their farm with new technology and equipment. Not to say they don't, and this isn't all of them, but that's partly just because, again, they're looking to get that relationship out of the doing business with you, and part of that is they want to see how you've done with other customers before they may adopt. One of the other segments we segment farmers into is what we call the performance segment. We call these farmers the high yielders. They're going to yield themselves to prosperity. That doesn't mean they are going to not care about the costs of their farm, but their winning strategy is to yield their way to prosperity. These tend to be the farmers that will be the early adopters of technologies, equipment, new products that companies are offering, because they want to try it out on their farm. And they typically want to try it out in a piecemeal approach, right? They don't want to just adopt carte blanche all over their farm. They want to try it out, if possible, one piece of equipment on one particular parcel of land. If I know it's a little bit harder to do that, maybe with crop protection or seed, right? You can try out new technologies on just one piece of land, but with equipment, a little bit harder to do that. But the point remains, they want to test it out to see how it works in their farming operation. Then if it works, they do want to adopt pretty quickly. Those, asking the questions to understand the approach that the farmer is taking, I think can go a long way. Because the performance farmers, you say which segment of farmers should you focus on? In my mind, those are the ones during this time of depressed commodity prices, high interest rates. They're the ones that are going to see the value in some of the newer pieces of equipment that are being offered because they want to improve the product that they're doing on their farm. The third kind of segment that we typically segment farmers into is what we call the cost or the economic segment. These are the farmers that, while the performance farmers are going to yield themselves to prosperity, these farmers are going to save themselves to prosperity. That doesn't mean they don't care about yield, just like the performance don't care about or do care about costs, but their first priority is looking at how can I save money on my inputs? How can I make getting the crop in the ground cheaper with what I already have? These tend to be a little bit better. These farmers tend to adopt a little bit quicker than the relationship farmers, but they tend to lag the performance farmers by a little bit as well. So they tend to be the mid. Once they see it proven, they see that it can maybe reduce their costs on their farm, they're going to start looking at a piece of technology or equipment once they've seen maybe the performance farmers down the road doing it and working on their farm. So that was a very long-winded answer, Andy, to say I think you have to look at getting to know the farmer, looking at the buying behaviors, and then from there, it really just goes back to understanding how your piece of equipment that you're trying to sell fits into the strategy of the farmer and impacts profitability.
Okay, so this is phenomenal for many different reasons. I mean, I used to teach marketing, and so all the different pieces from a pioneer to an early adopter, all the way to late majority and laggards, that all makes sense. And have you ever read the book Crossing the Chasm?
No, I have not actually.
It's good. I mean, it's more on the tech side of things, but it talks about how people adopt, and obviously it's not geared towards the farmer, but it follows that, essentially that bell curve of how people adopt, and they fit into those personas that you just mentioned. So, good book for you to read if anybody's listening that's in the sales and marketing side of the dealership. Also good. But I'm going to, reiterate what you said, and just to make sure I've got it right. So you've got relationship farmers, you've got the yield focused farmers, and then the cost farmers. Is that right? Do you have any research, and we can link it in the show notes later, on a further explanation to this, or do you present on this?
Yeah, I can provide some data on it. I mean, kind of a overall summary of what we have found through that research. And I should be quick to give a quick caveat. Mm-hmm. A farmer who identifies as a relationship, that doesn't mean they don't care about yield or cost. It just means relationship is the most important thing they're looking to get at when they do business with your dealership. So right. That's the when push comes to shove, the relationship is what's going to be the determining factor. So, but I can definitely provide some of the data and overview, because I think this stuff is fascinating. I, said at the beginning, part of my goal as a university professor is to help the ag supply chain be more profitable. So I'll be happy to share that. Yeah,
absolutely. And again, that caveat you shared is also shared within the Crossing the Chasm book, that it doesn't fit everybody exactly to a T, but it does explain kind of their leading personality of when they buy, why they buy, and how they emphasize different aspects that you're selling. And then the other thing that I wanted to bring up, just because, again, with like an integrated business solution like we have with our Anvil Pro, the CRM component is big, but people ask, okay, what do I want to catalog as, being important to a farm? And obviously, acres is one thing that's easier, but then setting up these personas within your CRM system could also be extremely vital, because now you're looking at, okay, I want to increase my amount of connected acres and I want to push precision. Well, I'm not going to look so much on those cost-cutting farmers. I'm going to look more at the yield side of those farmers. And then if I can categorize those guys down, and then all of a sudden now I can look, okay, have they purchased in a couple of years, and would they be willing? And I'd encourage dealers, like you said, to be creative, because it's not like you can run a seed plot, right? But could you borrow a piece of equipment? Could you do something else that allows them to be on that cutting edge to maybe have a 300, bushel to the acre cornfield, or at least a strip that they can test out? Then all of a sudden you can start to be creative and play to the success that they want. But you can't do it if you're not cataloging the right kind of data and not after the right kind of persona. That gets back to what you're talking.
Targeted marketing I'm an economist at heart, so I'm not a marketer per se, and please do not ever ask me to ever lead a marketing campaign, because I'm the least inventive person out there. But targeted marketing is going to be in agriculture in general, and I'm going to paint with a broad brush, so people may disagree with me. But in agriculture, we have typically tried to treat every customer the same up to this point. And over the last 10 years or so, we've slowly started to transition. I think other parts of the economy have already done this before agriculture, but we're not going to be able to treat every farmer the same. You're going to have to understand the value the value proposition your company provides to the farmer. And I know CRM, some people may hear that term and go, more data for me to input. But it is true. Having that data already inputted, so you know the persona you're going to talk to. And yes, the shoe doesn't always fit exactly, right? You could know you're walking into a relationship-driven farm and end up talking about yield because that's the flavor of the day, but it helps push your value proposition into the framework that the farmer is using on their farm, so they can understand how it's going to better financially impact their farm.
Mm-hmm. Yeah, exactly. It doesn't ensure 100% success, but it does help, stack the cards in your favor. And it also is just, it's relationship management. It's helping you understand that farmer better, so you're actually communicating in the way that they need to be communicated to, and helping them find the solutions that they're actually after.
Yep.
Yeah. Yep. That's
100% agree.
Good. Okay. Well, we could talk about this all day, and we might at some point in time. But I want to shift the conversation a little bit on farm financial conditions, because I know those are really important right now. And, tracking used equipment sales from the past year, I thought it was fascinating that 2023 was not as good of a year as 2022. And with commodity prices starting to weaken, about this time last year, we started to see corn come off of its high pretty drastically, beans doing it as well. But yet, we saw in December some record prices still happen. And I thought that was interesting and unexpected at the time, but when you look back at it, it's like, there was unanticipated profitability because, we had a dry year, but we caught the right kind of rains, had better than expected harvest yields, and farmers had a little bit of a boost in their overall profitability, so they had tax incentives to buy equipment, and that boosted the overall value of machines at the end of the year. But then there was also, almost psychologically, or maybe from a behavioral economist standpoint, there was a sense of scarcity that 24 was going to stink. People knew it. And they're like, this might be my last chance with some actual cash in my pocket to buy something. And it all, though, derived from the cash in the pocket standpoint. So we know that you've got to follow the cash to figure out what's going on. So what is your take on, the current farm financial condition, and then income profitability for 24, and maybe if you're really good at that crystal ball, like 25 and beyond?
Yeah, so, I think first off, to reiterate what we were saying, I think this is a perfect segue, because this is why that targeted marketing is so important, is the profitability, I think, is going to stay at these lower levels for the next couple of years. And with these lower margins, farmers, we still got to have food to eat at the end of the day, right? Consumers like me, we got to have food to put on the table. So people are going to have to continue farming, and we're going to need equipment and products to get the crops in the ground. So, while I think that there may be a little bit of a dire outlook on, this lower profitability, people won't be buying anything. I want to give the emphasis on what we just talked about, because people are going to have to do, farmers are going to have to put a crop in the ground. So understanding how your product can make that tight margin maybe just a little bit better is, I think, going to be a pretty powerful argument. Now, on the farm income side, one thing I want to say before we get into some of these numbers, because it doesn't look very good thinking about 2024. And I know we've had some very timely rains across part of the Midwest. I saw on social media yesterday someone standing next to like what looked like 10 or 12 foot corn. So, we're expecting some larger yields here in the fall of 2024. So that may help. Yes, price may be down, but we may yield ourselves to prosperity in some parts of the U.S. this year. There's going to be profitability out there. So the numbers that the USDA releases are averages, right? So there's going to be farmers that are going to be quite profitable even in this current depressed price environment, and have been through 2022 and 2023. So I think there's still a lot of opportunity out there in the agricultural sector for farmers and people that supply them moving forward, even with some of maybe the lower prices that some people are predicting. So if you look at the USDA numbers, net cash farm income is predicted to be down here in 2024. I think given what's happening on the world stage with trade and the deglobalization we have seen, the United States is a net exporter. Agriculture is one of our key commodities that we export around the world. Other countries have become more competitive, which is why we're seeing some of the lower prices. Other countries have ramped up production. This has increased quantity out on the world market. But two, just the emphasis on deglobalization. We've seen a lot of tariffs happening over the past 4 or 5 years, trade wars. We've seen over in Europe, right, Brexit. And, it's not just a United States thing. It's an all over the world political happening right now where free trade isn't as popular as it used to be. And that's a warning sign for U.S. ag, because we like to export stuff, because we typically have been one of the leading producers, cheap producers, because we have the technology and equipment to do it here and the climate. So that is something that, unless we see disruptions in the market, I don't really see elevated commodity prices happening anytime over the next couple of years. I hope I am wrong. I always hope I am wrong when I say a statement like that. But I do think that doesn't mean that there's not going to be profitability. I think that there will be ample opportunities for good producers and people supplying those producers to make ample amounts of profit over the next two or three years.
Mm-hmm. Yeah, I just saw something also on social media today that talked about the trend line for Brazilian corn and the amount of acres that they're putting in production. And it was always in the past that their infrastructure was poor. Well, they've improved that. And the only thing that we really have going for us versus them is we have the Mississippi. So our cost to port and getting it out of here is and will always be cheaper than what they potentially have. And then our soils are richer, so a fertilizer disruption wouldn't hurt us as bad. But other than that, it's, long-term picture doesn't look great for being competitive with Brazil unless they significantly ramp back deforestation. And then you've got China, where, is that something that you get into much about the purchases that China's making or in this year not making? And what's your take on, is their motive, is it politically driven, or is it just simply because, their swine herd is down, they're going through a depopulation and will for, probably from here on out. So is this just the way it's going to be, where China's not going to be as significant of a buyer as they ever were?
Yeah, I think the answer is D, all the above, right? The depopulation cannot be understated. They're having fairly significant population issues, right? They had the single child policy for a long time, and that has remained, and their population rates just aren't what they probably should be. So their population is expected or is declining and expected to continue. Yes, their hog population is down. So that's further depressing some commodity prices. Then you throw in maybe some of the political turmoil that on top of that, and that leads us to where we are today. I think the question is where do we move forward for agriculture from this point? I think the bright spot is that there's other areas of the U.S. that we can supply, right? There's obviously population booms happening in parts of Africa, India. So there's going to be demand on the world market. So I think that's some of the bright spots. Are we going to be competitive with some of those places? And how does that shape out in terms of it impacting our commodity prices? If you look at the USDA tends to break down profitability from year-over-year changes, and pretty much all of the decrease in profitability from last year to this year is from just pure price change, right? It's not any quantity change, producing less. It's all on the price side, which is a demand issue, right? Where are we going to find markets for some of the products that we supply here out of the U.S.? Again, I hate to be the bearer of bad news, all the above, but I think there's some bright opportunities. So, I think the main thing I'm trying to say is, I think if you look 10 years in the future, the world market is going to look different, right? And we're kind of in this transition phase where there's some growing pains. We're trying to find new players, new sources for our product that we want to ship around the world. And once we figure that out, I think we'll be all right.
Right. And I've talked in past podcasts and just had a webinar domestically too. There's a bright spot. If you look back into the early 2000s to see what ethanol did for the American farmer, there's probably nothing in the recent history that has boosted rural America quite like ethanol has. And who knows about the next renewable fuel standards and RAF and the chance for airline fuel. But not to say that it all will come to fruition, but if some of it does, there's good potential there. And then that's domestically controlled, which reduces the risk that we're going through right now.
Yep. So that's the income side. I think the bright spot for agriculture, and this is a good thing for equipment dealers, is the balance sheet of agriculture is fairly strong. Maybe not as strong as it was a year ago, because we've had to deplete some of that equity because of the lower profitability. So we've seen some of the equity erode or go away, I should say. But by and large, if you look at the liquidity and equity positions of U.S. farms, according to the USDA, here in 2024, the current ratio is still at 1.7, 1.8. So farmers have cash in the bank. Now, whether they want to do anything with it, because that is kind of the farmer's war chest that they have to weather a super big downturn, so I think understandably so, there's a lot of reluctant farmers out there that want to dip into their kind of cash reserves. But, that's a good sign. And that's, what kind of drives some of my thinking that the equipment market's going to be okay here over the next 2 to 3 years, because if a farmer really needs to make a change in equipment or a new purchase, they have the balance sheet to do it. It may be painful, right? They may have to give up some cash that they've been sitting on to as a reserve to make it happen. But they're going to be able to stay in business. Now, the question becomes, to your question about crystal ball, what, next 2 to 3 years, how long will that remain, right? In the current environment, I think we can go for quite a while, because as I keep reiterating, I think there's going to be some farms, quite a number of farms are going to be able to be profitable. But if that's not the case, we could see some of that equity and liquidity reserves dry up pretty quickly over the next year, 2 years. And, that would put us kind of on a 2026, 2027 timeframe. That would be where we would really start to see some issues. But I'm hoping that doesn't. I don't think it will happen.
Yes, I'm hoping as well. We farm in northern Iowa, so I definitely hope that doesn't quite happen as well. But you do have to be prepared. And then, a couple points that you just mentioned that we were talking about earlier. That's why understanding your farmer, and if it's logged in a CRM system and it's built into your sales process, is really important, because if they do have those good ratios and they are willing to spend, maybe not on everything, but something, then you know who they are, and then you know who to potentially call upon, because those people chasing the yields are still going to, if they have the cash, they're still going to be chasing those yields, and they'll want to do what they've always done, right?
Yeah. Well, that's what's got them to this point. That's what's kept them profitable, is that they're innovative, trying new things, seeing what works on their farm. So knowing that going in can help you, again, convey that value proposition.
Okay, good. And then, to kind of wrap this up, we talked about dealers can use this in a CRM system if they really understand the persona of their farmers. Any other way that dealers can use this understanding of the current, balance sheet of farmers to their advantage for the next 1-2+ years?
Well, I think that helps the dealership know what the farmer is capable of. If you're talking with a farmer in this current environment, elevated interest rates, so assets cost more to buy. And there may be some economies of scale issues, right? If you're thinking of, if you're looking at pieces of equipment to sell a farmer and the cost based on their balance sheet is going to be an issue, it may be worthwhile to say, okay, they're not going to be growing, so we shouldn't look at maybe the biggest model. Maybe we need to go down a size, down a tractor series, and get them in a better fit for what their operation needs at this time to get them through this tighter margin period, right? They're still going to need it. They still need profitability. But if their balance sheet says they're not going to grow, let's not extend them because that's not what their operation needs at this time.
That's great advice. And knowing some people that work in the banking sector and the lending sector, I think they would appreciate hearing that as well. That, working there from the consulting side of putting them in a better position to weather a downturn, that's appreciated.
Yeah, and I think any farmer, no matter what segment they would fall into, appreciates that more business partner approach.
Agreed. Good. Okay, so then to wrap this up, I typically ask the people that join me here on Beyond the Hood, something about a book or advice. And when I was talking to you about this beforehand, you stated you've never read a book in your life, I'm sure, right? But you actually didn't have a book, but you got a podcast. And I don't know the answer to this one. And so I'm actually looking for your second best podcast because I'm sure Beyond the Hood is your first. But what?
Absolutely.
Okay. Just to set that record straight. But what recommendations of podcasts do you have?
Yeah, so I have two. One for business, one for maybe more personal or going on a trip. So the business one, I'm an economist, so I'm always in favor of, if you're a business owner, whether you're an equipment dealer or a farmer out there, understanding the economic conditions and how that's going to impact you moving forward is, I think key to understanding what environment you're operating in. So I'm a big believer of the NPR, the Planet Money, and the Indicator podcast. The Indicator is where they do kind of their financial indicators of the day, which kind of tends to be forward-looking, where the economy may be going. Planet Money is more of a backward-looking, let's look at some stuff that's happened and try to analyze it through an economic lens. And I tend to just find those absolutely fascinating. I realize I'm an economist, so maybe that's just my inner nerd talking, but I will own that and give those a high recommendation. And I maybe less so that particular podcast in general. Just I would say stay up to date. My advice to my former self is read more. And I do that nowadays through podcasts because I've got a lot of windshield time. So really podcasts are my way of reading. But, so my advice to my former self is read more. Today I'm doing that through just learning about the economy, continuing to learn through kind of the business side of things and doing some economic podcasts. More on a fun side, I like to travel. So listening to travel podcasts, Rick Steves, if you've seen his show online, he does an excellent podcast where he'll break down parts of Europe. There's also another travel podcast called Out of Office that I really enjoy as I'm driving, where I think the latest city they broke down was like Louisville, Kentucky. And they go there and tell you, if you're going to be a family going there, what are some things to do and their recommendations. So those are kind of my two recommendations for podcasts. One business, one maybe more for fun.
Oh, fantastic. And like I said, I'm doing a dealership tour up here in Northwest Iowa, Southeast South Dakota. And I was in a subpar hotel the other night that had like 2 channels. One of them was Rick Steves. I think it was from the 1980s. But it brought back memories. And I'm glad to know that he's got a podcast because that guy's got a phenomenal voice.
Yeah, no, and his podcasts are fascinating because he really breaks down, what he can't do on television. He'll really take a deep dive into the culture, some things you may want to do or eat or see while you're in certain places. It's really interesting.
Huh. That one I'll be checking out. And I love Planet Money as well. So, yeah, everything's good. Okay, Brady, I appreciate all the time that you've been able to offer. And then to all of our viewers, make sure if you haven't done yet, subscribe to Beyond the Hood with Tractor Zoom. That way you'll get updates both from our new releases and then some of the video shorts that you can find on YouTube. And again, Brady, really appreciate this discussion. This has been phenomenal.
Thank you for having me.
Okay, everybody. Thank you for joining Beyond the Hood with Tractor Zoom. Until next time, I'm Andy Campbell. Take care.